right, welcome back to Live at 4, and it is now time for Money Monday. Because of a recent interest hike, our debt is costing us more, but our savings are keeping pace.
So with another rate hike expected, local financial professional Brad Allen from wealthwisconsin.com here to talk about what we can expect. So yeah, when interest rates go up and we borrow money for homes or cars or all those things, our rates can go up as well.
Yeah, I mean, the Federal Reserve is expected to raise the federal rates this next coming week. The 12th and the 13th is when they're going to meet. Now, they're going to raise the federal funds rate, which is the rate that banks charge other banks to meet the reserve requirements, right? So the rates are at about 1.5, 1.75%, but that has an indirect effect on the rates that we pay as consumers. So when the Federal Reserve raises rates, it does not directly affect us, but it has a trickle-down effect.
How long does it take to trickle down? Because I was wondering what that impact is when you start to see these rate hikes.
Yeah, so a good example is the average household has $8,600 worth of credit card debt in the country, which is up 8.6% from last year. So it's not that we're spending more money, it's that we're paying more in interest now. Interest rates continue to go up and it affects people. So what I always tell people is that you need to get that high interest credit rate, that debt paid off as fast as possible. So snowball that debt, or there's things out there like zero balance transfers. We can transfer your balance to a new card, pay 0% interest for a certain period of time. So take advantage of that kind of stuff because it's not going to last forever.
Credit card debt is, I mean, interest rates ridiculously high. I mean, they're in the double digits. When we look at savings, and we're like, okay, now let's go save some money.
Digits.
You would think it would have an impact on the savings accounts too. At 1.5% is what the interest rates have gone up since 2015, but savings accounts interest rates 0.01. Right? So that, you know, I work with a lot of retirees, people going in retirement, and they're looking for fixed assets that they can put money into. That's not going to be as volatile as the stock market. 0.01 is not keeping up with inflation. So you really have to shop around. There's places like credit unions, community banks, online banks that have higher rates for things like CDs and stuff like that, but you have to be careful.
Brad, before we run out of time, people thinking about mortgages or refinancing, is this a good time to do that with what's going on?
Yeah,
with the rate?
I mean, the average rate's 4.5% right now. The 30-year average is 6.56. So we know they're going to keep going up with interest rates going up. So if you want to refinance or look at buying a home, you know, we have a mortgage calculator on our website, wealthwisconsin.com, that can help you out along with that process.
Thanks for helping us out today. If you have a question for our experts, email them at asktheexpert@today'stmj4.com. You can also leave a voicemail. We do have the number right there for you.